Warren Buffett has been a multi-billionaire for almost 40 years. Much of his success is attributed to his incredible stock-picking skills. And, of course, don't forget a wide network of highly intelligent people surrounding him. From Benjamin Graham to Charlie Munger, these smart people shaped Buffett's investment style. But there is one ingredient that is often left out, and it is the leverage and cheap source of capital that Berkshire gets from its insurance business. This capital is called float. It is so important that Buffett often talks about it during shareholders' meetings and letters. But what is float? You probably made bank transfers before, right? But have you ever wondered why it takes so long? The typical wait could be 2 or even 3 days. That is ridiculously long. One of the reasons is of course banking software and fraud prevention. But if you follow the money trail, it turns out there is another reason. When you initiate a transfer, money disappears from your account instantly, but it doesn't appear on the other end for several days. Have you ever thought what happens to these funds on those days? The business term for funds suspended in the processing limbo is float. It is a funny term, as if money is floating somewhere in a parallel universe of banking. It turns out that banks can actually profit from float. They take this money and lend it to other banks to earn interest income while you wait. It is absolutely legal, but it's understandable why banks are reluctant to lower their processing times. Plain and simple, it will eat into their bottom line. For instance, suppose that a large bank makes about $100 million of transfers each day. If there is an interest rate of 4% a year, this earns this bank a low-hanging fruit income of $4 million. After all, there was $80 trillion worth of ACH fund transfers in the US in 2023. All this adds up to large income numbers for banks. The US federal system is trying to deal with this issue. The Fed introduced the so-called FedNow transfer system, which allows banks to transfer and send funds almost instantaneously. But the credit unions and banks were kind of slow to adopt this system. We can probably guess why. You may wonder what this banking example has to do with Warren Buffett. The thing is that we can find the presence of float anytime there's a lag between receiving money and sending them. And float serves as a valuable source of capital that can be invested and earn income for businesses. Warren Buffett realized this very early on in his investing career and has been an avid user of float. Let's take insurance business. The same concept applies as with those lengthy bank transfers. Insurance companies make money in 2 ways. First, they receive your insurance premiums. This is their so-called revenues. But they have to make payments for filed claims if something happens. That's their expense, so to speak. The difference between premiums and claim payments is their income or so-called underwriting earnings. But there is a second, even more important source of income. The thing is that there is a lag between receiving premiums and paying for claims. As a result of this, insurance companies accumulate large sums of money, which is float. Insurers invest their float in securities to earn capital gains, interest income, or dividend income. And this is exactly what Berkshire Hathaway has been doing for all these years. Buffett uses float as a cheap source of capital to invest in stocks of Apple, ExxonMobil, or buy other businesses such as See's Candy. In fact, there are many insurance companies that do not even earn underwriting income, meaning they lose money on their insurance contracts, sometimes even on purpose. Instead, they make up for this loss by earning outsized investment returns on float. So think of underwriting losses as a cost of capital for float. In other words, float is the capital, while underwriting loss is the cost. But there is this brilliant thing with Berkshire Hathaway. They run their insurance business so efficiently that they actually earn underwriting income, meaning that their premium receipts exceed the payments that they make on claims. Here's a graph that shows net underwriting earnings or losses for Berkshire. Overall, it has been persistently positive. For the past 20 years, Berkshire pre-tax gain on its insurance operations was $29.2 billion. Let's pause here and appreciate what it means. It means that the Berkshire Hathaway not only gets lots of float capital, but it also gets paid to hold on to it. It's plain genius. And the cost of their float has been negative, especially for the last 2 decades. And here are the words of Warren Buffett himself on insurance float and its importance during the 1995 annual meeting.
The question relates to what we have that long table we introduced about 4 years ago or so in the annual report that shows the amount of float and the cost of float, and that's a very important table. In terms of our operating businesses, that's probably the most important piece of information in the report, and that float is, as you noted, well over $3 billion now. Last year, because of various favorable factors, including the fact that our Super Cat business was favorable, but also because our other insurance businesses did very well, amazingly well. The cost of that float, which is money that we're holding that eventually does not belong to us, but will go to somebody else. The cost of that float was less than zero, and that is a very valuable asset. And the question is how much flexibility we have in investing that, which I think was the core of your question. The answer is we have a lot of flexibility.
Little has changed since 1995, except that the float ballooned 50 times. Here's a graph for Berkshire's float. It started from mere $39 million in 1970 and grew to a staggering $169 billion in 2023. That is a lot of capital that Buffett has been deploying profitably. In his 2019 letter to shareholders, Buffett underscored how important insurance business is for Berkshire. He called it collect now, pay later model, leaving Berkshire with large sums of money. I linked this letter in the description if you'd like to read more. It all started with Berkshire's acquisition of National Indemnity Company in 1967. Later, Buffett picked up Geico and General Re Corporation. As we see, Buffett has built an impressive insurance empire that serves as a cheap source of capital and leverage for Berkshire. Private equity firms and hedge funds also rely on leverage to invest, but they usually take loans which are high yield and have high interest rates. Conversely, Berkshire's float serves as a cheap source of capital for it and provides a competitive, distinct advantage for the company. On top of that, typically Berkshire Hathaway insurance business pays out no more than 3% of its float a year to cover its claims. And this leaves Buffett with a large chunk of float that he can deploy and with a minimal risk of capital recall. And that is it for this video. As always, thank you so much for watching, and give this video a like and subscribe to my channel for more content on investing and other interesting economic topics.